கூப்பிடுறேன். கொஞ்சம் லைட்டா கதவை திறந்து வை. நான் அப்பதான் ஏதாவது கூப்பிட்டேன்னா கூட உங்களுக்கு தெரியும். சரியா? இன்னும் ஆரம்பிக்கலையா?
Dear participants, kindly
கொஞ்சம் லைட்டா தர. Sir, good morning, sir.
Good morning, madam.
Shankar.
Madam, good morning.
Sir. Good morning, sir. Chitra, ma'am.
Good morning, sir. Good morning. Sankaranarayan, sir. Good morning.
Madam, good morning, madam.
Good morning, sir. Good morning.
Good morning, sir.
Dr. Chamundishwari, shall we start the program?
Yes, ma'am. Yes, ma'am.
Okay. So, good morning and happy morning to all of you. Hearty welcome to all of you to the third day faculty development program on the topic Smart Money 360 Navigating Taxation and Investment in the Digital Age. Today is the last session of the FDP, and today we are glad to have Mr. Shankaranarayan as the resource person. He is a chartered accountant and senior accounts officer in Chennai Port Authority. And actually, today's session is going to be the continuation of yesterday's session. In yesterday's session, we saw mostly about old regime and deductions, tax deductions under Section 80. And in today's session, we are going to see more about comparison between old and new tax regime. I am glad to invite a welcome you, sir, to this program. And I now invite Mr. Shankaranarayan, sir, to take over the session. Sir, please.
Good morning, all. I am very happy to join you today from Chennai. Today, the topic given to us is understanding between the two tax regimes. With this, I just have, yes, understanding the old tax regime and the new tax regime. This new tax regime is very new, recent concept which evolves for the last 2 years. This introduction here. Today's topic we will try to understand, focus what is the difference between the two regimes. First of all, I will give you a brief that why this new tax regime has come. See, in that previous tax regime, there are some lot of deduction and exemptions were there. These exemptions and deductions where it went out of control for the government that a lot of fake claims has arisen in the deduction. So, in order to curb that fake deduction and other things, government thought many ways to checking lot of control checkpoints. There are about say some 2 crore taxpayer filing the salary return. It is not practically possible for them with reduced manpower in the income tax department and considering all factors. They thought of this new idea, let us introduce a new tax regime wherein they have given what is the gross receipts and eliminating all the deductions which is available previously, thereby directly elevating the rates of the income tax, thereby giving the introducing a new regime which they given since they cannot lot of deduction has got ongoing effects. For example, a housing loan if you take, it is available for 20 years or 10 years or 30 years. You cannot just like that take away with few people may plan the tax accordingly. So what they given, they have simultaneously introduced a new tax regime as an option and let taxpayer decide which way he want to go. Whenever there is a new regime is introduced, always they will give more emphasis for going for a new regime. Accordingly, in this scenario also, initially they introduced with a very less base limit, but for this financial year, assessment year 25-26, that is financial year 24-25, they have elevated the tax slabs up to 12 lakhs, so that this new regime will be more beneficial for everyone, and they left the option very less people can go for a old tax regime. Next. In this, I will just brief before understanding that what is under, how you can opt for old or new regime. What are all the heads of income taxable under Income Tax Act? Next. See how I will give you a small brief how this income tax has been governed. The income tax is governed by 5 factors. One is the Income Tax Act, other one is income tax rules, the third one is notification circular issued by CBDT. With respect to this notification or circular issued by CBDT, they have to issue only a clarificatory in nature that cannot overlook the act or rules. The fourth one is Finance Act. What is Finance Act? A Finance Act is an act passed by the Parliament every February that will contains the rate of tax for the next financial year. That is the Finance Act. The fifth one is the judicial pronouncements. The maxims of this income tax taxation is exist in this five forum. That is the Income Tax Act, rules, CBDT notifications, the Finance Act every year, and the judicial pronouncements. Income Tax Act want to tax this income broadly classified the income as 5 category. That is income from salary, house property, profits or gains from business or profession, capital gains, other sources. I will give small brief about all these 5 heads of income. What partakes an income as a salary? No. Previous slide. Salary means there should be an employer-employee relationship, and the remuneration or the monthly emoluments, whatever the contract says, that partakes the income from salary. House property. For taxability and income under the head house property, the assessee, that is a taxable person. Here the taxable person is normally called as assessee. I will be using the term assessee, which means that the individual. The assessee who owns should own a property, that is they should be the owner of the property, a land or land appurtenant thereto, and he has to let out and earn the income. This let out income which is used other than for his business or profession shall be chargeable to tax under the head income from house property. Business profits or gains from business or profession, as you broadly well aware, if an individual or the company or any person who is defined under this act broadly undertakes a profession or a business, the income which he generates from carrying out such a business or profession chargeable to tax under the head profits or gains from business or profession. This capital gains, next head. Capital gains as the topic many salaried people may come across. That is, in case if you sell a property, that is in case of chargeability to capital gains, there should be a capital asset. That is land, building, or any capital asset defined under the act. Then you have to necessarily, there should be a transfer for a consideration. So in case if you transfer a capital asset, then such income is classifiable under the head capital gains. Other sources. Now, these other sources, everyone in this category, that is the professors or the salaried employees, may have this other source income, that is a dividend income and interest income from the fixed deposit, and this IPL, this betting, gambling games, the online rummy, all those categories are fall under the category of income from other sources. These are all the 5 heads of income. Why I just kept this slide 5 heads of income? Next, at last we come to know the setting off. That is how you can set off the interest loss from the house property into salary. For all those purposes, I just had this 5 classification of income, which is dealt under the Income Tax Act. I put as this slide. Next. Now, we will go the tax regime comparison. Next. The old tax regime, that is which we are all filing return of income up to the year 31/3/22. This new tax regime comes into the year from 23/24. Up to the year 2022, there is only one regime, that is this. Now it is called as old tax regime, which has got an income and it has got deductions. There are two places deductions were there. One is under section 10. Where is the HRA, conveyance, transport allowance, all those things taken as directly as a deduction under the head salary. And one more place, the deduction comes is the chapter 6A, that is called as the ATC popularly, that is the LIC, interest on this premium paid on mediclaim, self-medical expenditure, interest on housing loan, all these things. This you might have yesterday's session elaborately dealt what are all the deductions available. And other than that, the donation. All those things were broadly put into the old regime. Now, next slide. Now, what happened? The introduction of this new tax regime they have done away with all the exemption and deduction, and straight away they have increased the slab rates. For example, if you have to pay tax from just 2.5 to 5 and 5 to 10 as 20%, they have introduced the new tax regime wherein 20% will come for this financial year only from exceeding income 20 lakhs. So they made the new regime that the slabs, I will come next 2 slides where the slabs are there. The slabs of taxation, they have moved directly that very less amount of taxes will be charged at that new tax regime by eliminating the all deductions what is available for the old tax regime. Next slide. This I just shown how the tax slabs are practically available. Just to see the slide. You may observe that up to 2.5 lakhs, there is no tax. 2.5 to 5, 2.5 to 3, it is 5%. That is effectively 2.5 to 5 lakhs, it is 5%. 5 to 10 lakhs, it is 20%. And income exceeding 10 lakhs, it is directly 30% taxation were there in the old tax regime. This was up to the year 22, we are following. Every year what they have done previously, the tax slab, they were tax slabs from 1 lakh. From 1 lakh, they increased to 1.5. From 1.5, they increased to 2. Thereafter, they increased to 2 to 2.5 as a basic exemption limit. But suddenly the shift, what happened, they untouched this old tax regime, which is available with a lot of deductions. Thereafter, the net income, what is arrived, will be chargeable to tax under this tax slabs. Then what they have introduced is the new tax regime with different tax rates. That is the slabs. Next slide. If you see the new tax regime, up to 3 to 7 lakhs, it is only 5%. 5 to 10 lakhs, it is 10%. 10 to 12, it is 15%. 12 to 15, it is 20%. Above 15, here 30%. But if you see the old, the rate are exceeding 10 lakh itself, it goes for 30% slab. But here they removed the deductions. That is the only major shift and change they have made. Next slide. For this financial year, they have made this 30% slab for income exceeding 30%. For income category whose income exceeding 24 lakhs. This drastic shift, what they made for making 24 lakhs is anticipating the 7th pay commission, which the income gradually will go at least to a 15 lakhs for a least salary employee. So in such manner, they designed that from 12 lakhs onwards, the tax slab itself will start, and they put a very minimum slab from 4 to 8 5% and 8 to 12 as 10%. These are very fundamental things. So I am just moving little faster. I will discuss where specific areas where we face struggle and what we do practically. I will give you a big brief on all those aspects. Next. In old tax regime, we had deductions A.T.C., that is the LIC, and several list of items where we used to give the children's school fees, the interest component on the housing loan, ATD, the mediclaim, self-medical expenditure. All those things were there in the old tax regime. Now the shift has become to the new tax regime, letting taxpayer to choose the rates instead. Understand the impact of losing this deduction is critical for making an individual to take informed tax decision to choose which tax regime he can opt. Next slide. This one slide, what explains is the standard deduction. Now, in the previous old tax regime, the standard deduction is only 50,000, but now the standard deduction, they have made it to 75,000. This was come from the previous year. At present, whoever filing the return of income and for the current financial year, that is the ongoing live year, the standard deduction is 75,000. And in this, what are all the allowable deduction is that 80 CCD2. See, in this 80 CCD2, I will explain one thing. That is the 80 CCD2, we can take it as a deduction only if your employer has considered this NPS as forming part of salary. For example, I draw salary as 1 lakh. The employer has to contribute 14,000. So in my payslip, if they give my salary is 1,14,000, then only this 80 CCD2 can take it as a deduction. Actually, many taxpayers who is under new tax, that is the NPS, who is under the new pension scheme, or the CCS, what is given by the state government, they misunderstood and take a wrong claim, which they later end up into a notice. This 80 CCD2, we should take very cautious decision. That is, if your NPS, whatever paid by the employer towards your salary to the government account, if he has categorically included that in your gross receipts, or your gross total income of salary, then only this 80 CCD2 will come. Otherwise, this 80 CCD2 will not come. That you have to take note of it. Similarly, EPF and VPF, whoever not covered under this NPS, there will be something called EPF and VPF. If they included this EPF or VPF as a perquisite, taxable to tax as a CTC in your hand, then in that cases, this you are allowable as a deduction. Then the transport allowance for disabled, that is physically challenged people, some 40% category, 60% category, those will be there. If they are in receipt of a transport allowance, that is exempt up to certain limits under the new tax regime also. Conveyance allowance, that is if you do some official duties, whatever travel conveyance or all those allowances are given, that is considered as exempt. Then two more exemption continues in the old tax regime is that, the new tax regime is that the gratuity. Recently, they increased the gratuity from 20 to 25 lakhs for this year, and also the leave encashment, which has been increased from 3 lakhs to 25 lakhs this year. That is, previously up to 3 years back, the leave encashment exemption is only up to 3 lakhs. Rather than that is added to the normal income, and we are paying that tax on encashment also. Here, one more confusion, everyone doing some mistakes. That is, leave, they normally in employee, in all this government employment, there is leave encashment which is applicable every year, or you surrender some leave and you can get leave encashment. Whether that is considered as exempt, if you ask, no. The leave encashment, what is exempt up to 25 lakhs is that the terminal leave encashment. That is, at the time of your final retirement, the terminal benefits, what is given as leave encashment of your accumulated leave, which is up to 300 years in a year, is exempt up to the maximum limit of 25 lakhs. This has to be taken care into. Similarly, gratuity. For a gratuity also, the terminal benefit it is. For example, in case you shift from one employer to another employer, in such cases, you will get gratuity here, and you join new employment, you will get second time gratuity. In all those such cases, you should ensure that your lifetime, the total exemption what you claim, do not exceed 25 lakhs. That is the maximum limit prescribed, that you have to keep a track. That is the deductions now available in the new tax regime. Next. These deductions which are not allowed under new tax regime is this 80C, 80D, that health insurances, 80E, that is the additional interest paid on the housing loan, donations, 80G, 80 TTA, TTP is that for senior citizen and the normal citizen. You will be having some SB interest that was exempt previously up to rupees 10,000, that they fully taken away by introduction of the new tax regime. Then one important component, HRA, and the leave travel allowance. In this HRA, I will give some small brief. What happens, even I am as an employer, when I see, they launch HRA claim, even people, those who especially opted for old tax regime. What they used to give is that they try to give the PAN, exceeding HRA up to 1 lakh, no PAN requirement is there. If it is exceeding 1 lakh, you have to submit your employer the PAN of the landlord. What they mistake normally they do to claim this HRA exemption is that they give the PAN of a brother or their spouse or their relative and they leave as it is. Once, see, if you want to plan exactly HRA and you are giving one another person's PAN, you ensure that whether he has one house property and you have to execute an agreement and necessarily you have to transfer the rental amount to him through a banking channel. Then only this HRA you will able to claim. What happens? Everyone gives HRA claim along with other claims. Now many cases are taken for scrutiny. When they ask where is the proof of payment for rent, they are not able to establish because of the coming these days with the GP and other things. They are not in a position to substantiate that they paid through cash also. That is, some withdrawal should be there in their bank account to establish that they paid through cash. So if you claim any HRA, you ensure that it is an appropriate claim, or if you given anything like a tax arrangement for something, that you ensure that the claims and other things is in proper records are maintained. Otherwise, it is very difficult for you to establish when the case is taken for scrutiny. This housing loan interest and section 24B. Here also I will tell you one important thing, that is between the new tax regime and the old tax regime. That is, if you claim an interest on housing loan, which is allowable as a deduction for a self property, that is up to 2 lakhs every year. This one more important thing I will tell, before 2014 and all, the housing loan interest, whatever interest you pay, sorry, for example, 3 lakhs, 4 lakhs, 8 lakhs, that you directly set off against the salary. Because of this housing loan interest, government is not making much revenue because everyone buying 2 or 3 houses and they put all the loan and they adjust against the salary. So what government has made in the year 2014, they restricted this housing loan only to 2 lakhs. Thereafter, what they done now, they have done away with the new tax regime, setting off the housing interest with the salary income. That is, this housing loan interest still you can take. For example, if you have a rent of 3 lakhs and you pay the housing loan interest amounting to 2 to 2.5 lakhs, that you can set off in the 3 lakhs, the housing loan 2.5 lakhs, then 50,000 you can report under the income from the head house property. In case the rental income is 2 lakh and you paid a housing loan interest of 2.5 lakh, in such cases, this 50,000, in case you are going for a new scheme, you cannot set off against your salary. That 50,000, what you have to do? That 50,000 will be carried forward for the 8 years. In case any income accrues in the future year between these 8 years, this housing loan interest, whatever you carry forward, you can set off against that rental income only. That is the restriction placed in the housing loan, which is little ticklish to understand. That is the in this online class, whatever possible, I just briefing that. In doubt session, we will have one separate doubt session for say some 10 to 15 minutes. There you all raise your doubt. I will answer each thing to entire forum itself to the extent I know and as per the law what is possible. Other deduction and exemption, that all other deduction whatever you have, for example, the physically challenged people having a deduction, if their disability is less than 60%, they used to have 75,000 standard deduction. If it is beyond 60%, they used to have a deduction of 1,25,000. Like that, so many deductions were there. They simply done away by introduction of new tax regime. By opting for the new tax regime, you will get only the higher standard deduction of 75,000, but this exemption may go. Home loan interest, HRA, ATC. This tax planning, we have to do individual case to case basis. Still, if your old tax regime is beneficial for you, then you may go for the old tax regime. Otherwise, because of the lowest tax slabs, some 80 to 90% of the salaried taxpayers are opting for new tax regime only. Next slide. Next, income from house property. This is what I just briefing. The standard deduction 30%. For example, if you are having only the rental income and you are going to file the return of income, in that what are all the things allowed under the income from house properties? Standard deduction is allowed both the schemes. Income from housing loan, that is fully allowed to set off against the income from house property. If it is self-occupied property, up to 2 lakhs, you can set off against the old regime. In new regime, you cannot set off anything. Municipal taxes paid, whatever municipal, nowadays the municipal taxes in every city, especially Chennai and all those places, quite high. Previously, no one used to claim, but this nowadays everyone is making a claim against the income tax because the tax rates are quite high. It is coming even in Tuticorin itself somewhere around 6 to 7,000 for a 2,000 square feet house, and Chennai it is coming some 10,000 to 11,000 rupees per whole year put together. So all these municipal taxes paid, you can claim it as a deduction for the rental income what you earned against the house property. That is, the owner has to pay. If you given that client that the tenant has to pay, then you cannot claim that. You have to ensure. This is the deductions available for the house property under old tax regime. Next slide. New regime. That is, what are all the things allowed under new regime in the house property is that you are allowed the standard deduction. If it is self-occupied property, this 2 lakh is done away with, because if you are a self-occupied property, you cannot be able to set off against any other head of income under the new tax regime. Due to the restriction placed by law, by introduction of the new tax regime, this 2 lakhs is done away with. Last set off also is not allowed. Once the 2 lakhs is not allowed, you cannot in a position to carry forward the losses. This municipal taxes, whatever you have that you can claim. The co-owner benefit, for example, the house is held by husband, wife, or along with a co-owner, that equally they used to claim. That is available in both the regimes. That is the major shift. This interest on housing loan, they done away with. That is the major shift I want to highlight here. Next. This I just summarize what are available. Standard deduction available in both the thing. Only old regime, the 2 lakh set off is available. This I would like to say that in case an individual may want to go for old tax regime, if he has the HRA claim, that is, he is residing in a rental house and his native or any other place, he has housing loan as well as a own property. That is, he is having a claim of 2 lakhs under house property and he is claiming HRA where he is living a rental house, and also he is having ATC deduction including NPS contribution exceeding 2 lakhs. That is, if he is having a claim exceeding 6 lakhs, then in such cases for this year, he may go for the old tax regime. If any of the component do not present, that is, if your HRA claim is less than 2.3 or 2.4 lakhs, that is, your total claims is below the 6.4 lakhs, you may not be in a position to go for the old tax regime. Inadvertently, you have to go for new tax regime because the overall tax rates is lesser in the new tax regime. This house property was one of the important tool everyone planning for a taxation up to previous year 22. Now, because of the new tax regime, it has been done away with. And one more point of view, the compliance also is done away. Where the employer deducts the tax, the return filing will become very simple. Because in the gross income, whatever employer deducted taxes, without any allowances or deduction, directly he may be in a position to file the return of income, and the processing also will be simpler. That is the intention of the government to introduce the new tax regime. Next one. Next slide. See, this is one important aspect. That is Form 10 IEA. This is applicable for people, those who take any classes, private coaching classes, as well as engaged in a college, or professors having any other income, that is a business income. If you have a business income and you want to opt for old tax regime, then you have to file Form 10 IEA. And one more thing is that anyone having this, we gradually have some. I've seen one case, 2 cases I will explain practically. There is one person last year filed return of income who is having some Amazon, some commission receipts for referral. Normally, this app and all showing you refer someone, we will give some under commission 1,000 rupees, cashback 2,000 rupees. Like that, one gentleman has got some 2,000 cashback as a commission from Amazon. What happened? He is just a salaried individual. This 2,000 rupees, what he has done, he has put under other sources and he simply filed return of income. What Act says is that the department default classifies that as business income. In case that person who has opted for old regime and have any one small receipt as business income, he has to file this form 10 IEA. They have introduced this form along with this new and old tax regime. When you are when you want to understand between the old tax regime and new tax regime, and when you essentially have some business receipts, in such cases, this form 10 IEA plays a vital role because you want to go with business income with old regime. This 10 IEA filing is essential. If you do not have any business income, then you need not worry about 10 IEA. The filing is as simple as that. You can opt for old regime anytime. For example, I have opted for new regime under my employer, but at the time of filing return of income, I come to know I can go only for the old regime. You can go for it. You can simply go for it. Only thing is that one important thing I am saying, you want to go for old regime, you should necessarily file your return of income before the due date or the extended due date by the government of India. That is, for every year, 31st March, the due date is 31st July. This year, they extended up to September 15. It was told that there is some system related issues the department is facing releasing of the forms for filing return of income due to introduction and done away with all the deductions. They have give extended time up to September 15 for the current financial year. So if you want to file your return of income under old regime, you should essentially file before the due date. What happen if you misses the due date? Still you can file and you have to file return of income, but only option available is the new tax regime. Since if you have any huge amount of deduction and you missed the due date, apart from late filing fee, that is 1,000 to 5,000 now they are collecting. That is, if your income is below 5 lakh, they are collecting a fee of 1,000. If it is exceeding 5 lakh, the late filing is 5,000. Apart from the late filing fee, if you file the belated return of income, you cannot opt for old tax regime. Next. One more thing here is that if you file your return of income within the due date, and if you filed under new regime or old regime, you can revise your return of income up to 31st December in this year. Up to previous year, they allowed up to 31st March. From this year onwards, they shortened further 3 years, and they further shortened the processing time also. Simultaneously shorten the revised return filing time up to 31st December. You can file your revised return of income. One more doubt you may ask, how many times you can revise the return of income? Yes, you can revise your return of income any number of times up to 31st December. Which return will be considered for processing? The return what you filed at last, the last return what you filed by you before 31st December. That revised return is the return for all purposes. All the previous return shall be struck away from the system. This is the one of the important key aspect, and this scheme, that is the old regime, new regime. Understanding regarding old regime and new regime. If you want to file under old regime, you have to essentially file within the due date. If you are filing a return of income after missing the due date, you cannot file under old tax regime. You can necessarily go for new tax regime only. This who should file the form 10 IEA? A salaried individual who do not have any business income that I told you just before. He can opt out for the new regime any time. That is at the time of declaring to the employer for TDS purposes or at the time of filing return. Whichever is later, he can change for the any tax regime. For him, this 10 IEA is not essential at all. Income with business or profession wants to opt for default no regime. He can, without filing this 10 IEA, he can just like that go for. He want to opt for old regime. He has to file this form 10 IEA. And then only he is allowed to opt for old regime. Once a business income person opted for new regime, he has no option. He has just to continue in the new regime only. He cannot go for the old regime. At least for the term of 5 years, he has to continue in the new regime only. For business category, due to carry forward and set of losses, lot of other benefits and deduction is given on that head. They are placing restriction on switching on the schemes. That is the aspect. Here, what will happen? Some professionals, they are getting exclusively 2 lakhs, 3 lakhs consolidated pay and getting only 194J. Those individuals has to take care while filing this professional income that they should ensure that 10 IEA is filed before filing the return of income under old regime, and they have filed the return of income within the time limit. And this any revised return, all those things they are doing, they should do before the 31st December. Next. This I told you, switching between salary, no business income can choose every year. See, for example, last year I filed return of income in the old regime. This year I want to go for new regime. Yes, you can go, no problem. Last year I filed in new regime. This year I want to go for old regime. Yes, you can go. Only person having business income, he cannot switch. He can switch only once. And if he opt for new regime, he cannot go for old later. He has to continue in the new regime only. If 10 IEA is not filed, a person having business income, in that cases, what will happen? This he cannot, his return will be processed as new regime only, and the deduction will be by default disallowed, and he has to pay the higher taxes which is applicable for the rates applicable on the new regime. Next. Next. This, as I told you earlier, you have to think, you have to work out what is the taxes available under the both regimes, and accordingly you have to, you see which tax is coming lower to you. This, there is a lot of Google calculators also is there in every site, clear tax or whatever the case may be. You can go to all those things, you can apply whatever all deductions you have, you choose which is very wise to you, and accordingly you can opt your employer the tax regime. The default tax regime wherein employer will deduct tax is the new tax regime. In case I have not made any declaration to the employer to opt which tax regime, employer will deduct on new tax regime only. If you want to old tax regime, you have to give specifically declaration in form 12BB, that is a prescribed form under the Income Tax Act, wherein you have to choose the regime also in that form. Accordingly, the tax reductions will be made for you in the respective regime. Next. This choosing is on individual tax planning strategy only. There is no thumb rule. As I told you, if you have the 3 deduction for a salaried individual, which is HRA and house property loss, as well as 2 lakhs loss from the 2 lakhs deductions from A.T.C., you can go for the new tax regime. Otherwise, you can go for otherwise you have to go for the default new tax regime. This is the conclusion. Next. You should compare the overall tax implication and you have to choose. Now I will give for your doubts. Whatever doubts you have in this tax filing, either current year filing with your form 16 or the next year planning, you may post it. I will be able to answer you.
Thank you, sir. Dear participants, you can post your doubts in the chat box. You can also
Participants
unmute
could
your
raise their questions.
audio and ask your doubts.
Sir, if possible, could you please share any real life experience or common mistakes you have seen related to tax filing or tax audit, sir?
Yes. I will tell you. This HRA, what happens? They see, I told you already. This HRA, what happens? They simply gives the spouse or other person's PAN number, wherein that person also employed somewhere. What happens? If you give that PAN number, your employer will file your form 16, noting that PAN number for the deductions. What happens is that for that person, whatever you claim as deduction will go as income. what are all the things you have to consider for filing is that before filing, you have to thoroughly check what is your Form 16. And you have to thoroughly scrutinize your bank statement, what all the credit is there. You cannot miss any credit. For scrutiny, if it is taken, if the bank credits is the credits you have not reconciled properly and accounted for income, any credit which is income you missed out, that will be added wherein you will get the penalty. And the important thing is AAS. For example, you may not know what interest, what are all the bank statements you have, what fixed deposit you closed in the beginning of the year or later of the year. You have to thoroughly scrutinize the Form 26AS as well as the annual information statement, which is available after login to your portal. That things you have to thoroughly check. In that, what all the credit is there, you have to see whether that credit pertains to you. For example, what happens in practically this some cases, the PAN number erroneously typed by the bank, wherein that person do not have any fixed deposit, but it has pop up in his AAS. He did not see that and proceeded filing return of income. Immediately he got a notice stating that you have some 10 lakhs of fixed deposit income, kindly rectify your return. After that, he struggled to rectify and correct the same. So you have to essentially see this AAS. In this AAS, they have given an option to reply whether this credit belongs to you. This credit do not belongs to you. There is something called an optional reply column is there. If you give reply, then that will go to that person who has filed the erroneous return, where he is given an opportunity to correct it. That is one important thing I wish to inform you. This AAS, if you see something which is not belongs to you, you can give a reply over there and you need not consider. If you given reply, the chances of triggering notice by the department will be very less. Similarly, you should ensure more caution in the online portals where you generate income. Those income you have to, if you earned any income, there is nothing lost. You have to appropriately consider that income which is credited to your bank account or something, and you have to disclose it in the return of income so that your processing will be better. In case if you have a refund, if you do not disclose this, that will get delayed or your return itself may be rejected if you not disclosed under the appropriate head of income.
So one participant is asking you to explain section 80 CCD again, sir.
Yes, 80 CCD. See, 80 CCD has got two parts. One is employee contribution, other one is employer contribution. Employee contribution, that is your own contribution, which is deducted from your salary, which is included in your gross. Then, along with other 80C deduction, you can consider your limit up to 2 lakhs. For example, my 80CCD NPS is 1,20,000. I have other 80C like life insurance premium, housing loan interest repayment, all comes to 2.5 lakhs. If you do not have NPS, your limit is only 1.5 lakhs. If you have this NPS, your limit is 2 lakhs that you can default claim in your return of income. In some government employments, what happens? The employer contribution 14% is also considered as your income as a perquisite. That is, my income is 1 lakh. Employer contributes 14,000. That what he does, he put in my payslip 14,000 as my gross receipts. In such cases, whatever employer contribution is there, up to 14%, that is all employer does up to 14% practically. In case if he does beyond 14%, that I will explain separately. If he does up to 14%, this is 80 CCD1, he can claim it as a deduction. In case there is in gross receipts, your employer not included the 14%, you cannot claim below line item that deduction. That is employer contribution also some individuals are claiming. That is what is reflected in my NPS statement. For example, for me 10,000, they pay every year 24,000. They multiply this 14,000 into 12. They multiply and they claim it as deduction in the 80 CCD1. That mistakes don't do. Those people are getting notices. They have been stuck up at the time of taking notices. You got what I am telling? Or I need further clarification?
Yes, sir. Yes, sir.
That is the thing. If your employer included in your gross, you have to make a claim. If your employer is not included in your gross, then in 80 CCD1 while filing return of income, you should not make any claim. That is allowed as actual basis. Whatever your employer is giving that contribution to you, you can claim it as a deduction. That is, the employer contribution, government don't want to tax from your end. That is only they given that deduction in even new tax regime also. In defense and all those places, what they do, the employer contribution also they considered as payment to salary, which they don't credit to the employee account, they credit to the employee's NPS account. That they allow as a deduction under A.P.C.Mahalaxmi.
Sir,
Thank you,
there is
sir.
another
One
one
more
question
Yes, madam.
regarding policy maturity or surrender value amount, whether it should be included for assessment or not.
No, madam, it is a capital receipt. I will tell you what are all the capital receipts. Capital receipts need not be shown. Exempted income. Normally, agricultural and other exempted income is there. That is actually immaterial, but still it need not be shown. Maturity, see, there is two types of maturity is there. There is taxable maturity, exempt maturity. Exempt maturity, you just keep it in your record, that is in your computation statement, and you keep your bank statement with a computation statement, reconciled statement in case if they raise any query from the bank statement, what is the source of this receipt. Some policies which is your contribution is less than 20% of the sum assured, that is your contribution per annum is exceeding 20% of the sum assured. In such cases, the policy maturity is taxable. That has to be shown as a income. One more thing I will explain, this EPFO also. If this EPFO, if you have at the time of terminal benefits, if you withdraw, that is exempt. But what happens if they withdraw within the 5 years term or during the course of the employment, or they should show the employment, if they withdraw the entire sum, that is taxable. Even that EPF will deduct some tax in that. That will be clubbed, added to your normal income. You have to pay tax on that EPF withdrawals. This is the aspect involved in this EPF also. Many people put EPF when they switch over, when they withdraw, including the terminal benefit, that time it will become the taxable receipt. You have to give the minimum time period up to your retirement. Otherwise, that arises in case of a EPF.
So there is one more question.
Yes.
Whether interest on post office FD account is taxable or not.
Yes. Interest on post office deposit is taxable. Someone is getting other doubt is that they invest on tax-free bonds, whether that interest is taxable or not. That is taxable. Only thing exempt is that when at the time of investment, whatever they make under ATC, that is the tax-free fixed deposits, tax gain fixed deposits, that is exempt only for the purpose of investment. There is two category of investment, wherein it is exempt at the time of contribution, exempt at the time of return also. Other type of investment is that they are exempt only at the time of contribution, not the return. The taxable component in that is that someone is getting confused here also. If I deposit 1 lakh, the proceeds come to me is after 5 years, say some 1,60,000, 1,70,000. Whether 1,70,000 is fully taxable, if they ask, no. The taxable amount is 1,61,000 less the amount invested, rupees 1 lakh. The net 61,000 is only the taxable amount. That they have to consider for taxation. That is the interest earned alone is considered for taxation, not the entire proceeds. Because someone getting doubt, since at the time it is exempt, now I have to fully tax. No. The taxable component is only the interest component, not the entire investments made. That the entire profits you realize in your bank account. Everything you have to work out.
Thank you, sir.
Everywhere some hick will be there in the income tax. That is the beauty of this law. They told they will simplify with a new tax regime, but we end up with further complications.
So there is one more question regarding deduction for maintenance expenses of disabled dependent.
Yes, madam. That is also done away with the new tax regime.
Okay.
For either your case or the dependent case, the limit remains the same. That is, if you are there is one form is there, you have to obtain from the government medical practitioner. I will confirm in another 5 minutes who is the exact designation. You have to obtain one prescribed form, Form 10E or I think Form 10E. I'll confirm that form. That form you have to obtain for making that deduction. You need not upload the form in the return of income. It should be kept with you during that year for the specified ailments or the specified disabilities. That is below 60% of the they will qualify what is the disability. If the certificate issued for below 60% disability, you will get 75,000 deduction. If it is exceeding this 60%, you will get 1,25,000 deduction. For dependent or self, you can make a claim.
So there is one more question regarding maturity of gold bond scheme, whether
Yes,
it is taxable or not,
yes,
how to
yes,
treat
ma'am.
it.
The similar way, how much you make investment, you have to deduct. You have to deduct the principal invested and the profits. See, if you want anything to be exemption, as I told you, it should be specifically stated under section 10, or it should be stated specifically under section 80 in order to claim under chapter 6A. If it is not specified under any law, the taxable, the principle behind taxing is that the revenue receipt is getting taxed, not tax on tax. The principle what you invest that you have to deduct, then you have to arrive the taxation of the remaining sum.
Thank you, sir.
The gold bond
Participant,
arises like that. In case of a mutual fund, in case of a shares, that is a financial instruments if they define. It is taxable as short-term capital gain or long-term capital gain depending on the period of holding. The period of holding is very crucial for taxing a mutual fund profits. And in this mutual fund, if you incur loss, you can set off for the next 4 years. Even in case of shares also, if you incur any loss, you will be in a position to set off in the next 4 years. You have to carry forward in next year if you accrue any profit that you have to set off. This filing return of income, you take more care when you deal in any online platform. One another gentleman who is my friend has got some difficulties where he earned this IPL, where some betting incomes, and he filed a normal return where he claimed a refund. His return is not processed at all because he failed to disclose this income, and that income is a betting income which is taxable at higher rate. He earned very 2,000 rupees because of not disclosing that his return struck, and making that return into process, it took a lot of time. So for that only I am suggest is that you go through your annual information statement, which is a link available in the income tax portal, or your tax practitioner, you obtain that annual information statement, you print out and keep it with you, and you ensure that whatever receipt is there, it is your receipt only. Since it is at implementation stage, some receipts what is declared in your EAS may not be belongs to you, wherein you have to give specific reply in the EAS itself. And you analyze everything and thereafter you proceed, because you are filing return to the departmental portal. They will straight away compare immediately with the EAS and Form 26AS. I think Form 26AS I need not explain. You might aware because that form exists for the last 17, 18 years, which will contain how much your income and what is the TDS deducted. That is the proof that you see the TDS deducted is reflected in your account. These two things you have to analyze carefully and proceed for filing return of income. If you have any clarity, you have to discuss with your immediate consultant or the auditor, chartered accountant. Get it clarified and carefully file. In these sessions, you have any doubt, you can get clarified, and you can take this also to your chartered accountants so that they will be in a
sir,
better
what
position.
about indexation of long-term capital gains, sir?
Indexation, madam. See, this indexation concept now they are slowly removing as a part of the new tax regime. There is cut-off date is there, 23rd July 2024. What happens if you acquire a long-term asset, a property, a land or building? I will tell one thumb rule here. That is, in case if you hold a property, that is a residential building, and you are selling that residential building and you are buying a residential building only. There is no limit on number of houses you should hold. In case you dispose a property which is not a residential asset, that is a land you are selling, and you are investing in a residential property, you will get that capital gains exemption. See, I am going little high level language. I presume that you are aware of the exemption schemes available for a investment in residential property. In such cases, what happens is that you should hold maximum 2 property in your name. If you dispose a property which is other than a house property, that is a completed residential property, and you go for investments, you can hold only 2 property, including the newly bought property. In these cases, after indexation, the net income you can invest. Because you asked indexation, I come to that point. This indexation, they are slowly done away with. What they do, if you have a property purchased before 23rd July 2024, every year they will notify the index. The index starts from the year 2000. What happens if you purchase a property prior to 2000? You have to obtain from the register office or this taluk office, that is, what is the market value of the property in the year 2000. Then that value will be the value for the purpose of indexation that you can index up to the year of transfer. If your property is sold after this 24, what happens is that this indexation, you have two options. With indexation, you can pay tax of 20%. Without indexation, the purchase cost minus the sales cost minus the cost of improvement, you can pay the capital gains, net capital gains you have to arrive in that the tax rate is 12.5%. For the properties purchased prior to July 2024, the assessee has got once again two options like this new regime and old regime. He has to choose which is most beneficial to him. He has to plan along with that investment in case of disposal of a property, either in a new house property or the capital gain bonds. At present, NHA and RAC bonds, they can invest up to rupees 1 crore. Previously, it was 50 lakhs. Now it is revised up to 1 crore. They can plan where they want to invest. Accordingly, they have to decide the taxation under the head capital gains.
So
Thank you, sir.
Thank you, sir. There is one more question
Yes, yes,
regarding
yes, please.
The same section 80CCD.
Yes.
What about the taxability provision of section 80CCD in case of new regime?
That is what I told. In case your employee contribution, no deduction is allowed. Employer contribution, they considered that employer contribution in your gross pay slip, that is your monthly pay slip, then that employer contribution alone allowed as a deduction. That is one crux point. Because what happened in defense especially, they consider this employer contribution also a payout to that specific employee. That equivalent amount they allow as a deduction. My view is that some point of time, employer contribution, they will remove this deduction and they tax fully. Everything they will have some intention, this government. Some futuristic intention. That is the thing. They introduce this, or they will reduce some percentage, they increase some percentage. That is the idea behind this. You got clear, madam?
Yes,
Dr.
sir.
Anandi, I think
Yes,
it was
yes.
your question.
Yes, madam, please.
So there is a question regarding
Yes.
how much amount is taxable for interest from fixed deposit?
Interest from fixed deposit. See, interest from fixed deposit along with your regular income, if it is, you have to arrive the total income. In that total income, you have to compute tax. If your total income do not fall below 12, exceed 12 lakhs, then you need not pay tax. It is taxable on slab basis only. There is no exemption for interest on fixed deposit. Up in the old tax regime, 50,000 exemption was there. That is done away with in the new tax regime. 80 TTB for senior citizens only. 50,000 is exempt under new tax regime. Sorry, old tax regime. That is done away with in the new tax regime.
There one more question in the chat box, which is
Yes, yes.
posted by Dr. Karthigeyan.
Yes.
My salary income is 50,000 per month. I
Okay.
didn't submit any ITR. My management gives me TDS on behalf of me.
Yes.
Whether it is enough?
Yes. You have to file your ITR. See, you have to understand one thing. The tax starts from 4 lakhs. If your basic, that is, I am selling, you under section 139(1), the basic limit not chargeable to tax is 4 lakhs. If your income is below 4 lakhs, you need not file return of income. If your income is exceeding 4 lakhs, you are under obligation to file nil return of income. One more thing, I will tell you the other way. If you do not file return of income, even if they ask any notice that something like that, nothing will happen because you discharged your full tax. But it is advisable and it is obligatory to file return of income.
Thank you, sir.
Your late filing fee will come in such cases. In case, say, there is only 0.01% chances that your non-filing return is taken for scrutiny. We have such a bad luck in that year, then you have to pay the late filing fee in that cases. See, first thing about tax, you need not worry much. It is only a matter of money that we will necessarily earn. Only thing is that to save that, you have to plan something. First of all, we should not fear or worry for taxation.
So how
Even
much
if you
the
pay
late filing
something,
fees, sir?
even if you pay penalty or something, we should feel proud and much more proud that it goes for the welfare and growth of the nation.
Sir, how much amount is the late filing fees, sir?
That is 1,000, madam. 1,000 below 5 lakhs, 5,000.
So it's based on the income of.
Yes. If you
Okay.
file nil return 1,000,
Oh,
and if your income is exceeding 5 lakhs, it is 5,000 rupees.
Good morning.
so the time of the fine amount, sir, how within 3 months or
Yes,
4 months?
yes. I will explain this. If you file your return of income before 31st December, the fine amount is 5,000. Now what happened? There is something called modified return they have bought. For example, if your tax is, you need to pay, if it is fully, you are discharging only on TDS, and you identified that some income which is in your bank credit you missed, you want to file, you can file up to additional 2 years, wherein what all the missed component is there. You can file a modified return paying 25% and 50% additional tax. For example, your tax amount, example I am saying, your tax amount is 10,000. You are filing beyond 31st December. You have to pay 12,000, that is 12,500 rupees as tax, as a modified return. If you are filing beyond March, it is 15,000. Plus interest will come on the unpaid component. That is, you will be having TDS or something which is paid within the due date. Whatever you want to pay out of pocket, for that interest and the additional tax will come. With that, you can file up to additional 2 years also.
So not in a single year, sir.
Sorry?
Not in a single year, we have to pay for the consecutive years also. That's what you are trying to say.
No, madam. I am saying is that if you omitted return of income last year, up to 1 year, they given a slab of 25%.
Okay, sir.
Next year, they are telling that if you are filing 2 years belated return, this is 31/3/25. Now
Okay.
you are filing a return which pertains to 31/3/23. You
Oh,
can still file. They given option, but
okay.
the additional tax is 50%. If you
Oh,
want to pay 10,000, you have to pay 15,000 plus interest and this thing. And one more thing is that this modified return you cannot file for claiming a refund.
okay, sir.
You
Thank
want to disclose your additional income, which is omitted while filing your return of income, you can file still after 2 years with the additional tax component. See,
Okay.
government want to make, or in other way, they want to give option. They want to make revenue. So why to miss it? Let us take it. If they are willing to pay and willing to rectify the error, they can pay some premium, like this tackle ticket or premium tackle ticket, and still they can disclose their income.
Okay, sir.
Some
Thank you.
persons really, though, who are the cases coming for these cases? When people apply for passport and all, they want to have some higher income. In such cases, really they had some income and they are of the view they missed it, or they want to show some higher income. In such cases, people are going for this modified return and utilizing this. Everything is utilized positively. What I see practically here.
So there is one more question
Yes.
related to taxation of interest on savings account,
Yes.
whether it is exempted or taxable.
Madam, it
It's
is fully
asked by
taxable,
Dr.
madam.
Abdul Rahim.
It is fully taxable under new tax regime. Up to 10,000 is exempt if you are under old tax regime.
Thank you, sir.
Fully taxable. That is a problem here now. You cannot keep any money in SB account also, or keep it in house also. Everywhere this taxation is curbing in. You have to keep a minimum amount and you have to move for some taking some risk shares or mutual funds, wherein that period tax will not be there. After 1 or 2 years, the tax rate will be little lesser.
Okay, sir. Thank you, sir.
That is the tax planning you can do if you have little higher side balance in your SB account. You should be kept in very liquid funds after the minimum funds where you can sell and get it immediately.
Thank you, sir. Dr.
Thank you, sir.
Chamundeshwari, shall we wind up this session?
One more question is there, ma'am.
Okay.
Kumari ma'am is asking the form name for disabled dependents. Sir,
I
please.
that I will give form 10E. I will confirm you that. I will text you 1 minute.
Okay, sir.
Ten IA. The farm
Okay, sir.
name is
Noted.
10 IA. That farm they have to obtain at least in the level of the head of the department from a government hospital or a central civil surgeon. They have to obtain from that category. They will be having some board wherein the physically challenged person has to make an application to the government hospital. He has to after test he has to appear before the board. After that, some due procedure they are issuing the disability certificate, that form 10 IA. I think they will issue with some validity, some 5 years, 8 years like that, based on the disability, or some disabilities they will issue for lifetime also. That is the discretion of the medical practitioner, that is the doctor, and that competent board. That form they have to obtain and kept ready to claim that deduction. That is essential. Even if they want to submit claim to the employer also, this form 10 IA they have to submit. Not only their physically challenged ID card alone suffice the requirement, this 10 IA is mandatory under income tax.
Thank you, sir.
Thank you, sir. Thank you so much. Ma'am,
So,
shall I propose the vote of thanks?
so before that, a few words, Pa. So today's
Okay.
session was very valuable and highly informative. I thank our resource person, Mr. Shankaranarayanan sir, and all the participants. And we wish this journey to continue in future also. And I now invite Dr. Chamundeshwari to propose vote of thanks.
Thank you, ma'am. Good morning, everyone. On behalf of the organizers and all the participants, I take this opportunity to extend my heartfelt thanks to Mr. Shankar Narayanan Ravichandran, Senior Accounts Officer at Chennai Port Authority, for taking time out of his busy schedule and delivering an insightful and enriching session on understanding the old and new tax regimes. Sir, your vast experience as a fellow chartered accountant and your exposure in handling complex income tax matters during your tenure at Mrs. B. Tyagarajan and Co., along with your significant contribution at VOC Port Authority and now at Chennai Port Authority, clearly reflected in the depth and clarity of your presentation today. The way you broke down the provisions and practical implications of both regimes made the topic not only accessible but also highly relevant for all of us. We are indeed grateful for the valuable knowledge shared and the real time perspectives you provided. I'm sure the participants have gained much clarity and will be better equipped to make informed financial decisions. Once again, thank you very much, sir, for joining us and adding great value to this program. Thank you all. Thank you, sir. Wonderful session, sir.
Thank you, madam. Thank you.
Wind up the meeting. Ma'am,
Chamundeshwari,
shall we wind up?
let the participants leave the meeting, Chamundeshwari. A few
Okay, ma'am.
participants, they have to fill the feedback link, no?
Okay, ma'am. Okay.
Okay. I've asked Dr. Muthulakshmi to post the feedback link again and again.